Good afternoon. Good afternoon, everybody. Welcome, traders. Great to see you here. Welcome to ActivTrades Monday Market Matters webinar for the 9th of December 2024, where we are here today with our education element to focus on simple risk management. Great to have you all here with us today. I hope you've had a good weekend, and I hope you're ready for what's going to be an interesting week in the markets. Lots of interesting news coming out, and of course that will give us an opportunity to engage. Okay, so what are we going to talk about today on our agenda? As always, we'll look at the news and how that impacts Monday market matters for us for the week ahead. And as I said, today we're going to talk about risk management. And as always, I understand, we have a broad range of experience of people who join us for our sessions, whether it be live or whether watching it on the ActivTrades YouTube channel later. As always, we just appreciate that, some people at the start of their journey, some people are very experienced, but there's always something here for people to be able to take away. And what we can focus on here is, what is risk management? How do we employ it in our trading, and why is it so important? And then what we'll also do is we'll switch across to the live markets and have a look at those a little bit later on in our session. So always plenty for us to discuss, always plenty for us to cover. It would be interesting to know, for those of you joining us here for the live session, how many of you would consider yourself to be good at risk management? How many of you make sure that it's an active part of your trading agenda every day? It'd be interesting to know. Just put it in the chat box what your own thoughts are on risk management. I'm always keen to understand how other people engage with markets. As always, here on Monday Market Matters, we're here to basically to help you frame the start of the week in the right way, as we just prepare for the opening of the US markets in about 25 minutes time. So Mondays, 2 o'clock London time, we look to cover the major news for the week ahead. As I said, there's plenty of it coming down the pipe for us this week. Always have a main element on education, talking about today risk management. We'll always have a look at the ActivTrades platforms and tools that you have available to you as a client. And then we always finish with a look at the live market at the start of the US session as we start the week. So there's always plenty for us to discuss, always plenty for us to cover. And as always, you're very welcome here, and you're always very welcome with your questions, your comments, or just even your own personal experiences. Okay, everybody's on a journey, and everybody's on that path. We're all at different parts of it, or different points, but ultimately we're always on that journey towards trading mastery. For those of you who have joined us, for all the way through Monday Market Matters, you'll know that I will constantly go on about how, if you're a new trader, I don't expect you to be able to analyze the data, but it is unbelievably important that you know when the data is coming out, okay? Because that data will, induce volatility into markets, and volatility is very much a double-edged sword, all right? When you're on the right side of it, fabulous. When you're on the wrong side of it, it can make your trading challenging. So it's in your best interests to know when the economic data is being released, and you can find that on an economic data calendar. There is an economic data calendar on the ActivTrades website that you can access, and other ones elsewhere on the internet. So there is no excuse not to basically have a look at the start, the economic calendar at the start of the week, start of the day, even the start of the session. So we've always got plenty coming out here. So we've had a Chinese inflation rate, which dipped a little bit today as it came out. But what we're starting to get interested in is that for us here in the UK and in Western Europe, overnight tonight we will have the Australian RBA interest rate decision. And whilst the market is not expecting any cut at this session from the 4.35 that we're already sat at, what we are expecting is to see a little bit of clarity in terms of whether the RBA are looking to turn more dovish on the economy itself, and whether that has an impact on future interest rate decisions. And it's quite a week for interest rate decisions, okay? Quite a week for central bankers calling the shot, so to speak. We also have on Wednesday, in terms of US data, we will have, as you can see there, we've got the CPI data, the inflation rate data. there is still a keen interest in that inflation rate because the last couple of bits of data have demonstrated a little bit of an uptick, or that inflation wasn't as ebbing as fast as perhaps maybe people had hoped or needed, and of course that feeds in to the decisions that's required by Mr. Powell and the American Federal Reserve next week. We also have a Canadian Bank of Canada interest rate decision on Wednesday, and unlike the Australians, here they are expected to cut by about 0.5% from 3.75 down to 3.25. And once again, that's sort of an insight into inflation in Canada, but also more importantly, the sort of state of the economy. On Thursday, we will have considerable amount of data. Once again, in terms of interest rate decisions, we've got the SNB, the Swiss National Bank, with their policy rate decision, and they're expected to cut as well, expected to cut by 0.25% from 1 down to 0.75%. And there is also the ECB, the ECB, the European interest rate announcement, and they're also expected to cut as well by 0.25%. And then as we get into some of the data towards the end of the week, there is the American core PPI, there is also UK GDP, and also some unemployment claims in the US. So it is a busy week, There's a busy week with four central bankers making their statements, 3 of them expecting cuts, 1 of them to hold. So, of course, this will be a busy week. And as I said, when we get these kind of major bits of data, then you've got CPI and PPI and unemployment claims and also UK GDP. There's lots of things there that can induce volatility into the markets. And as I said, it's in your best interest to understand exactly where and when that data is coming out, so that you can plan for it accordingly. With all that central bank data and all that kind of news data coming out, what becomes supremely important is, even if you are, let's say, a longer term trader, maybe a position trader, maybe a swing trader, it is still unbelievably important for you to manage risk around big news events, and it becomes all about how you actually view and manage risk itself. And there's a quote here by Mr. Soros, and I appreciate some people love him, some people loathe him, and that's perfectly fine. The divided opinions, that is what makes a market, and ultimately that's what we're looking to operate within. But Mr. Soros was a supremely successful and active hedge fund manager, and this quote here from him is absolutely true. The secret behind success is to embrace risk, not to avoid it. And as you hear me always say, it's very easy to come out with these pithy sayings, and it all sounds very good and it sounds very wise and sage, and we all nod our heads and say, yep, that's fabulous. But the reality is, that's great, but how do I turn it into something I do? Right? How do I actually turn that into a plan that I can follow? Right, and that's what I'm here today as we talk about sort of simple risk management for traders. And as I said, I appreciate there's some traders at the beginning of their journey who are just totally understanding. Others who've traded for a while and will have their own views, and hopefully there'll be something here that will still help them refine and improve their own approach to risk management. So I would define it as this, in terms of, the sort of risk and money management 101, in terms of an introduction, my view would be, and this is a personal view, you are a trader. And so as a trader, it is your job to take risks, right? It is your job to take risks. Therefore, it is your job to manage risk. And what I have seen, as I said, from my own experience, from working on trading floors, from coaching, mentoring thousands of traders over the years, is that the better you become at managing risk, the quicker your progression as a trader will be. So what are we going to cover here, right? What are we going to cover? We'll have a talk through a few things. And as I said, we're just doing it at the simple level to help, new people at the start of their journey sort of grasp and embrace, A, the importance, and B, how to do it. But also, as I said, traders at all levels, it's really important to invariably ensure that you are making sure that you are managing risk in every way, in every session. So, In particular, we'll talk a little bit about definitions. We'll talk about how much we risk on a trade, how to position size for each trade. We'll also talk about how we protect ourselves from financial catastrophe with things like protective stop losses and why they're important and why you use a stop that makes sense. There'll be a few little money management rules towards the end, okay, before we conclude and then move across to the charts. As I said, this is a very simple, okay, it's a very simple starting point, but I will talk more about that in terms of my own views on it as we go through our session. Another quote from Mr. Soros, namely that my principle is to survive first and make money afterwards, all right? And that is truly important, okay? And lots of new traders have it the other way around, and then they wonder why they struggle, okay? Lots of people will call themselves a trader, but in many ways, it would be more savvy to define yourself as a professional risk manager. That is actually what you are. You're a professional risk manager and a speculator second. I have, as I said, I've worked in markets for many, many years. Okay, worked on trading floors, coached and mentored, thousands of traders. And, I can honestly say that I don't think I've met anybody who has been long-term sustainably successful who has not managed risk first and foremost. All right. Some people, they might get a little bit lucky for a while, but they might hope to have the odd winner. But luck and hope, they're all very good, but that's not the basis of a good trading plan. All right, for a speculator, your principle is to survive first, and you do that by managing risk. You do that. You manage risk first and foremost. All right, that's what you look to do. So if we break it down into a couple of simple rules that we could live by and that just form the basis of the way we operate, well, what I always talk about is rule one is live to fight another day. Okay, so that's actually, for those of you who don't know, that's a photo of from an old day at the office in terms of that's a jet fighter in the gun sights of his enemy. All right, your job is to live to fight another day. Okay. And I'm going to explain how you do that in a couple of slides, but that should be your rule. All right, you always live to fight another day. Your trading career should never, ever be defined by one single day in the market. All right, you live to fight another day, and I'm going to share with you how we exactly do that. And your rule two is you never, ever find yourself in a trade without an exit plan. Okay, you always have an exit plan when you enter a trade. And once again, we're going to go into that in a bit more detail over the next few slides so that you can keep those two rules. So long as you keep, as long as you keep to those two rules, you'll be okay. Okay, you'll be okay. You'll survive. Okay, long enough to acquire the skills that would allow you to prosper in the future. And that's what we need to be looking at doing. So firstly, what we have to recognize is, where are the exits? Okay. And this might sound very strange to someone who's completely new at trading, but in many ways, your exits are more important than your entries. So, I speak at trading conferences. It's been very great to speak at trading conferences with Vikesh and the ActivTrades team. Okay, and of course, speak at conferences, speak at meetups. Speak on sessions like this, and invariably, lots of new traders. Everybody's excited to talk about their entries. Everybody's fascinated by their entries, and I understand. It's a key part of the interest, but I'm here to share with you a little bit of insight, namely that long-term sustainably successful traders are more focused on their exits. Okay, you focus on your exits, and you've got two exits: where you get out when your trade ideas fail and you're wrong, and where you get out when you're fortunate enough to be right. And before any trade is placed, you should know where those two exits are. You really should be on top of that. It would be interesting to know, if those of you here today for the live session, how many of you at the moment live by that mantra, namely that, make sure that you always know where your exit is, where your trade is placed. How many of you? And it's fine. You can be honest. There's no judgment or anything from me. None whatsoever. It's more a case of this is an opportunity. If you've not been doing that, just almost to make a kind of like a personal commitment to yourself to basically to say, right, from now on, I'll live by those rules. I'll live to fight another day. And never ever enter a trade without knowing where my exits are, knowing where those two exits are, and that's fine. It's all part of you evolving to your next level as a trader, all right, to becoming the best trader that you possibly can be. So Simon says, perfecting stop loss is something I've always done, and actually calls like this are also something I do to commit to that mantra. Excellent, Simon. Thank you. Thanks for that feedback. Thanks for that insight. And you're absolutely right. Okay, you can never get lazy or complacent when it comes to risk management. Okay, you need to sort of embed those mantras into you so that you understand it fully, completely, and then it becomes almost like a subconscious part of your way of operating in markets. Now, as the slide says there, risk profile is a very personal thing, and we all sit on a spectrum. Some of us are very risk averse, okay, we avoid risk. Some of us are very accepting of risk. Some of us are very comfortable with risk. And what I would suggest is that every trader needs to know where they sit on that spectrum. Are you risk accepting at one end of the spectrum, or are you risk avoidance at the other end of the spectrum? And once again, it's a case of, just being honest with yourself, okay? If you want to, if you know where you sit on that spectrum and you want to share it in the chat box, by all means do. I'm always fascinated to hear. And as I always say, there's never any judgment. We're all traders on our own journey, as I said earlier. But it's a very personal thing, okay? And if you're not sure where you sit on let's say that risk profile or that risk spectrum, the best way to do it is, as you trade, to make sure you keep good records of your trades so that you can able to look back and start to identify, where you were comfortable and where you were uncomfortable, and what your sense and feeling was about the risk involved. And from that, you'll start to build a picture of your own particular risk profile. And as I said, it's a very personal thing. It's a very personal thing. There's no right or wrong necessarily. It's important to know what your risk profile is, okay? It is really super important. But as a starting place, okay, in terms of risk profile, as a starting place, and to ensure that we meet those first two rules, okay, rule one, live to fight another day, rule two, never end a trade without an exit, and knowing where exits are. What we can do to help ourselves with that is to basically to have a very, very simple risk management plan. And so we have it very, very simple. Namely, we never risk more than 1% of our trading capital on a single trade. Now, some people might risk a little bit more, some people might risk less, and that's absolutely fine. Remember, risk profile is a very personal thing, but if you're at the start of your journey, or if you've been struggling with risk management, my suggestion is just make it simple. Make it simple, make it clear. You never risk more than 1% of your trading capital on a single trade, okay? And I don't mind repeating it because it is so important. You never risk more than 1% of capital on a single trade. If you do that, okay, then what happens is then you meet rule one, okay? Remember, rule one is live to fight another day. But the thing is, what does that actually mean? How do you turn that into the numbers that you work with? All right, how do you make sense of that? So let's take a little bit of a deeper look into that. So then we're starting to look at, well, actually, how much do we risk on a trade? What does that mean? If I'm only ever going to risk 1%, what does that actually mean, Paul? So let's say, hypothetically, that we have a trading account of £10,000, or maybe it's $10,000, maybe it's 10,000 euros, 10,000 Aussie dollars. 10,000 Mexican peso. Okay, I appreciate we have a truly global audience who join us. All right, but it's about just understanding. We've got a trading account of £10,000. If we are following our rule to only risk 1% of our trading account on a trade, how much does that actually mean if we have a trading account of £10,000? Now, I appreciate some of you who are very quick with the mental arithmetic will be able to work that out and fire it into the chat box. Others may need to use a calculator. That's fine. Okay, that's fine. The important thing is that you understand the concept and that you actually get the numbers right. That's fine. And if that takes you a little bit longer, that's absolutely fine. Okay, that's absolutely fine. But if I have a trading account of £10,000 and I'm only ever risking 1% of my trading account in a trade, and I'm looking at, well, actually, how much am I risking? Well, my entire capital, okay, my capital risk is £100, okay, off a £10,000 account. That is 1% of £10,000. That does not mean I'm trading at £100 a point. That means that I'm only going to lose the maximum loss I could take is £100 for the entire trade, okay? Now, I'm hoping the people here with us today, you recognize that you can work that out, okay? You can sort of see that and hopefully take that on board as a way and a means to understand what's required, okay, in terms of your basic level, all right? Trading account £10,000 or whatever it might be. Trading account might be smaller, it might be bigger, but we only risk 1% of our trading account, okay? That is our capital risk. So if that's our capital risk, well, then the next element we need to have a look at is our position size, right? So, if we're only going to risk 1% of our account in a trade, well, how much does that mean per point or per tick or per pip, depending upon what you're actually trading? So let's have a quick example here. So as we said before, we've got a trading account, a hypothetical trading account of £10,000. We know we're only going to risk 1% of our account on a trade. So we know that our total capital loss is £100. For example, in this particular trade, we are going to go long the euro against the US dollar, and it's presently trading at 136. Okay, 136, the handle of 136, 13600. Okay. We know our entry. And as I said, we always need to know our exit. In this particular case, our stop loss, our exit, if we're wrong, is at 135.80. Okay, just think about it. The stop loss is 135.80. So how many points of trade risk do we have in this particular example? If we know our capital risk is £100, how many points of trade risk do we have based on a long entry at 136? With a stop loss at 135.80. Super, Simon, straight in there, 20 pips, etc. Yep, spot on, all right. Well done, Simon. Okay, very quick. Now, I appreciate that's not a terribly difficult one, but, I appreciate it's Monday afternoon. Everybody's just getting into their week. So we now know our capital risk is £100. Let's just bring this up, okay? Let's just bring this up. Florian's asking, what should we do to prop firms where even if we have 10K or more, the drawdown is only 5%? So, Florian, that's probably outside the remit of our session here today. But I would say from my own personal experience that your 5% drawdown, that is your account, okay? And that is your trading account. So think about it in those terms, not the size of trading power that they give you, but actually the drawdown, the size of the drawdown, that is your trading account, and think of it in those terms. But as I said, that's kind of probably a little bit outside the remit of our session today, but thank you for the question. So, yep, as Simon and others have said, the trade risk we have in this particular case is 20 points. So, if we are risking £100 and our risk is 20 points, how many pounds per point can we trade at? And this is a case this would be a case for more of a spread betting, but it's also equally applicable to trading CFDs, FX, etc. So if we're risking £100, our capital risk and our trade risk is 20 points, how many pounds a point can we trade at? And in that case, that is £5 a point. And that is what we start to look at doing when we are position size. We work out our capital risk, which is 1% of our trading account. We work out our trade risk, which is the difference between our entry and our stop loss. And then we're able to divide one into the other, gives us the position size, okay? And that is how we start to just ensure that we meet rule 1, that we live to fight another day, and we also meet rule 2, that we never enter a trade without understanding where our exit plans are. So I'm just giving some very, very simple examples here, just to basically give people insight, jog memories. There is some great content on the ActivTrades website and the ActivTrades YouTube channel, okay, that goes into deeper details about risk management today. I just want to make sure that everybody has an understanding, okay, of the most, let's say, the most basic, the most sort of standard fundamentals that you need to know when it comes to managing risk. What I will say through my own experience over the years of coaching, and teaching thousands of people is that money management is actually is actually one of the simpler topics in trading to grasp, though for many it seems to be the hardest to follow for many traders. And it'd be interesting to know whether that line resonates with your own experience. It is that difficult to understand, but many traders struggle to implement it on a day-to-day basis. Many traders, they struggle and fail because they have no understanding of, or they place no importance on, risk management, money management. But what tends to happen is that they score poorly on a thing called the disposition effect, where without that sense of money management in place, most traders, they simply hold on to losing positions for an extremely long amount of time, but take profits on their winning positions far too prematurely. And I see this time and time again with traders. They hold on to losing positions for too long and they snatch at their profits, right? And that doesn't really help them at all. Or they just place no importance on money management and risk management, and that gets them into trouble. And I'm here to tell you that actually it is basically one of the more simple topics to grasp in trading. Okay, it can be very simple, very simple. Okay, in terms of you just make sure you meet those two rules. You always live to fight another day, and you never enter a trade without an exit plan. And your exit plan is about ensuring that you understand position sizing, which is about understanding your capital risk and your trade risk, and that as I said, you never trade without a stop loss. These are just very simple rules that basically make sure that you are acting as a professional risk manager. Simon says, I think psychologically, humans aren't geared towards healthy management of money, as we are taught that holding small gains is correct. I had to unlearn to do it the hard way. And that's a good point, Simon. Okay, and thank you for contributing. Thank you for your comments. Yeah, as I said, there's a thing called the disposition effect, and human beings, as I said, they snatch at profits but hold on to losing positions for far too long. Right? I was tested for it about 10 years ago, and I scored very well on it in terms of I tend to cut my losses and run my winners. Okay, but that is because I've been trading for many years, and as I said, overall risk management has been one of my edges in trading. All right, the fact that I have the self-trust to do the right thing. Okay, every trade, every session, every day, every week, every month, every quarter, every year. Okay, and it it's one of my edges, and it makes a difference. Simon's asking, what's that test called? What the testing is for the disposition effect. But if you were to look on the internet, I'm sure you'd find plenty of information on it. My test, I actually had to go as a university test, and they took swabs of my. They took swabs from my mouth to work out how I managed cortisol and adrenaline, and also I had to do a series of computer trading tests and stuff about that to basically work it out, and I scored very well on it. Okay, in terms of the disposition effect. So, but it is a fascinating thing to look into, and knowledge dispels fear. So, if you are struggling with holding on to positions too long and snatching at profits, go away and sort of just have a look at the disposition effect. As humans, we struggle with it, but having good, simple risk management and money management principles and protocols in place can help you hugely. And so I would commend you all to take that on board. So to help us with that, okay, another one of our golden rules I'm showing is protect yourself at all times. You protect yourself all times, and in trading, you're doing this via the use of a protective stop loss, because trading without one, okay, ignores the damage that markets can do to you if you are not fully understanding and fully prepared, okay, and you're not on top of your risk management game. And it is unbelievably important, ladies and gentlemen. Really, cannot stress it enough to you. Remember what I said right at the start. Rule 1, okay, live to fight another day. Rule 2, never enter a trade without knowing where your exit plans are. Having a protective stop loss, right, is part of meeting those rules, because protecting yourself at all times and in every trade needs to become a subconscious habit. You need to build the habits around that. Okay, so I had a background in managing battle management for the Air Force. They're all exceptionally keen on risk management, so I brought that. That was an edge I brought to my trading. All of you here will have had different experiences. Okay, we all have different experiences, and it is about understanding the strengths and weaknesses throughout your, let's say, your journey, your experience, and how can you leverage your strengths and how can you mitigate your weaknesses. We all have them. Okay, anybody who tells you that they have no trading weaknesses, is talking rubbish. Okay, they're talking nonsense. We all have them. It's about how do I leverage the strengths that I bring to trading and how can I mitigate the weaknesses. But to do that, you have to understand what your strengths and weaknesses are. So be sure to join us for our session on Monday, 23rd of December, where we're going to talk a little bit about that. Okay, about giving you a little bit of an exercise to do over the holiday period to basically help you understand your own strengths and weaknesses. But it's important, protect your stop losses. You need to protect yourself at all times. And if you take a trading loss, do not take it personally. All right. Everybody takes trading losses, okay? Everybody, it is part of being a trader, and it's actually how you manage that is what actually helps you evolve to being your best trading self. Trading without a protected stop loss, okay, is outright exposure to financial trouble, okay? And I don't want that. We don't want that for you. So with that in mind, there are multiple types of stop losses that you can use. I'm going to just talk through a couple of them here today. So in terms of multiple types of protective stop losses, there can be technical analysis stops using your charts to identify. There can be financial stops, just basically having a stop based on, a financial number. You can have discretionary stops where people might just, place them as and when they please, based upon their own discretion of the charts. Whilst there is a stop loss, it's not one that I would recommend to people. Some people even have psychological stops, namely that they will place their stop loss based upon the amount of psychological pain that they can endure. Once again, whilst that might be a way to do it, I would not in any way recommend that you do so. Some people will use stop losses based on volatility, and that can be a very useful way, okay, to basically to place your stop loss, and we'll have a look at one of them as an example. Some people use percent stops. So basically, if their trade or even their investment has drifted, 10, 15, 20% away from its highs, that might be enough for them to exit the trade. I think that might have some validity in investing, but I would not necessarily commend it in trading, but it might be seen to be better than no stop whatsoever. And some people, myself included, for my intraday trading, can actually use a time-based stop. Namely, if you're into a position and it hasn't performed in a certain amount of time window, well, then I'll be ready to basically to cull that trade. So there are lots of different stop losses. You have lots of different ones. Today, okay, we're just going to focus on technical analysis stops with a little bit of volatility, and we might have a chat about common sense stop loss psychological stops as well. So, as I've said, technical analysis stop losses. Okay, so for example, this is an old example. This was Google on a weekly chart. Okay, Alphabet, as we know, many people, new people would know it, but those of a certain vintage will always be Google. And part of that is using lines of support and resistance as your stop loss. Okay, or fractals. Okay, fractals are these small little triangles here. That is a indicator on the ActivTrades MT5 and MT4 platforms. But in this case, this was a big bullish flag pattern. Okay, you can see there, big bullish flag. There's the flagpole, there's the flag, and actually, standard technical analysis would be, you'd be entering as the trade breaks out of the flag, okay, and looking for it to target the flagpole. But then, of course, that's the entry, but I'm always looking at the exits. And so, a very simple exit might well have been beneath this support line, okay? Or, depending upon your risk profile, maybe your stop is beneath these levels of fractals here for a little bit of a tighter stop. The important thing is that you're just basing your stop based upon what the chart is telling you, all right? Based upon what the chart is telling you, looking for levels whereby if the trade is triggered, and then turned around and actually falls away, well, then your idea has failed and there's no need for you to be in that position any longer, okay? And as I said, that's part of that disposition effect. Is some people, they will hold the trade hoping that it will come back. But I can assure you, after many, many years of trading, that hope is not a strategy when it comes to trading, ladies and gentlemen. Another version of a technical analysis stop loss that people might use is something like a trend line. So this is a chart on silver, and what we're hoping we can see is that there's probably people. This has been in a downtrend. There'll be lots of people basically shorting those positions in silver, with basically a stop loss behind the trend line. Okay, behind the trend line. And might be working on a fact that once price breaks through and closes the other side of the trend line, that is where their short position is. Their short position is over. Now, of course, people who've got some good technical analysis skills and good trading might have realized that the trend was over here when we start to form a higher low. However, as I said, a trend line, it is a viable one, and lots of people use it. One of my own good trading buddies, he likes to use a trend line as a stop loss. As I said, it is better than no stop loss, and it gives you an idea of, just looking at places on the chart where you are trying to identify, where is my idea wrong? Okay, where's my idea wrong? And that's, once you know that, well, then basically you can get out here and make sure your loss, or your profits are either harvested or your loss is small, rather than when you're actually out here far, far away. Okay, that's the wrong side of the disposition effect. This is an intraday example on the Canadian dollar against the Swiss franc, and this is where we might use something like a volatility stop loss. So you can use the ATR, the average true range indicator, which is available on the platforms. Okay, you can have it on just the standard setting. It doesn't need a particular fancy setting. But what we might do is, if we are placing our trade, in this particular case, we're using 2 times the average range as our initial stop loss. So in this case, it was CAD Swiss franc. We were basically looking to short as we'd gone through the sort of triple top here, and we're looking for it to reverse and take our short. And, we know where our entry was, and our stop at that particular time. Well, at that particular time, the average range for the 30-minute chart here was around about 9 pips. So our stop loss is going to be 2 times the average range. So our stop loss from our entry would be 18 pips away. Okay. Now, some might say, well, Paul, I could have just put it above the highs here. I could have, that's not as elegant. And that's, it's a perfectly fine, comment. But for many traders, as I said, who are maybe struggling with their chart analysis at the start of their journey, or are basically struggling just to commit to having a stop loss in place, sometimes something like this is very simple. It's very mechanical. It means there's no subjectivity, there's no ambiguity. It's very clear. My entry, I know where my entry is. My stop loss is 2 times the average range for the time frame that I'm trading on. It's there just in front of me on the indicator, and I just put my stop there. And now I know where my entry is, and I know where my exit is if I'm wrong, okay? And I also know what my trade risk is as well, which means, I know enough of the data to understand and do my correct position size. So for many people, at a starting point, if you're struggling, just even having, as I said, a volatility stop loss based on the ATR indicator is a very simple way to do that. And, and I'm very happy to commend that for people trading. Other people might use, and this is what I see, kind of more for the kind of huge, big institutional sort of fund managers, is that they might have something like using a particular level, all right, a particular level or price as a stop loss, okay, almost like a discretionary stop loss. So in this particular case, they're using this is trading Brent oil on the weekly chart, and they're using the big round number of $50 as the stop loss. Now, once again, it's better than no stop loss, but as you can probably see, it's a considerable distance away from where the price is itself. As I said, it's better than no stop loss, but there are better ways you can do it. Either looking at the fractals to identify if you're long, to identify the recent levels of support, or even, as we've just looked at, something like the average true range indicator that is very simple, very mechanical, and that can help traders enormously. And if you need help, well, actually, in terms of protect the stop losses, one of the other indicators you can use is PSAR, which is available on the ActivTrades platforms. Okay, parabolic support and resistance. And what you can perhaps see, this is a 4-hour chart of Tesla, and we've got ourselves into a nice uptrend. What you can see is that as price pushes higher, price prints of just a dot beneath the candles, okay? And of course, when price is above that, then we are basically buying. And then what we do is every time that the PSAR prints a new dot, well, this is where we'll be moving our stop loss to, okay? Moving our stop loss to until it flips, okay? Until price breaks it, and that is where we're taken out. So once again, this can be a distance away from the price. However, for those of you trading who are struggling, okay, to basically identify where stop loss is or to basically place it properly, this can be an enormously helpful way of allowing you to basically know where your stop loss is, follow that until your trade is taken out. So it becomes mechanical. It's not subjective. You just follow it, and gives you a bit of clarity and a bit of help for those of you that start your trading journey, just to basically work in the right direction, okay, and ensure that you have a stop in place and ensure that you can manage your position. So that is the PSAR indicator, as I said, and it is available on all the ActivTrades platforms. So, in review, just to prepare our trade, just to make sure that we know exactly what we're looking at, what we're doing. This was a trade of mine from a while back. What we're always looking to do, okay, in terms of managing our risk so we can meet our rules, we're always looking to quantify our trade risk, okay? Namely, our entry price versus our exit price. So in this particular case, this was the trade may have pulled back to the 200 moving average, and then it looked to bounce. I knew my entry was here, and I knew my stop loss was beneath these 3 pin bars here. And so I knew my stop loss was there because if price had triggered and then fallen away, my idea was wrong, and that's fine. Okay, that's absolutely fine. So I knew where my entry is, I knew where my stop loss was. Okay, so I knew what was my trade risk, the difference between my entry and my stop loss. Okay, that's what I always need to know. I also wanted to be able to quantify my possible reward, which is my take profit. Remember, this is my exit price at the target if you're right. So up here, I was looking for my target to be in front of a level of resistance, which was also a big round number. Okay, so I know where my entry is. I know where I'm getting out if I'm wrong. I know where I'm getting out if I'm right. Okay, my trade plan is nice and simple. Okay, nice and simple, and I can work with it. And by doing that, by knowing where my entry is, where I'm out if I'm wrong, and where I'm out if I'm right, well, now I'm in a position to calculate my reward to risk, which is, effectively the number of points between my entry and my stop loss and the number of points between my entry and my target. And now I'm in a position to, as I say, calculate my reward to risk and to see whether that trade meets my personal asymmetric reward to risk rules. So, that's what you're always looking to do in terms of when you're planning your trading plan. Where's my entry? Where's my exit if I'm wrong? Where's my exit if I'm right? Okay, that's what you should always be doing. And then from that, you can work deeper into understanding the number of points, understanding your capital risk, understanding your position sizing. And that means that you're able to meet rule 1 and rule 2, which we started off with at the start of our session. As I said, it takes you into a point where you can identify your trade risk divided by your capital risk. Okay, that is what gives you your position size, right? That's what we're looking to. That's what we're looking to achieve. Remember, your trade risk is the difference, okay, between your entry and your stop loss in points, and your capital risk is the monetary equivalent of 1% of your trading account. These are the elements we're having to work with. Okay. Here, and I do recognise if at the start, right at the start, your trading journey might seem a little bit challenging or a little bit overwhelming or intimidating. I assure you, just the more you do it, the quicker and easier it becomes. As I said, there is plenty of material and content on the ActivTrades platform and on the ActivTrades YouTube channel that can help you. Okay, and I implore you to basically take all of that data on board and learn how to manage risk, because it can be, as I said, it can be one of your edges. It certainly has been one of mine. And just a few simple money management rules, okay, that you'll hear traders talk about, I've learned over the years, is that, part of this is that disposition effect, okay? Disposition effect, namely, limit your losses whilst letting your profits run, all right? And we're going to basically, there we go. As I say every week, ladies and gentlemen, I am a better trader than I am an artist, all right? Disposition effect, have a look it up and stuff. Keep your position sizes within reason, okay? Remember, we talked about here, capital risk should be 1% of your account. Know your reward to risk ratio, okay? And that is key, because ideally it should be asymmetric, all right? And what I mean by that is, if you're risking 100 pips on a trade, well, then you're looking for a trade to make 150, 200, 300, 400 pips, okay? Risking 100 pips to make 10 pips might seem good at first, but actually it rarely works out. Always ensure you're adequately capitalized. Remember what we said, never ever trade without a stop loss. Never add to losing positions. Never move your stop against you, okay? So you might have placed your stop loss in a place, but don't start to think, oh, I'm going to remove my stop loss or move it to give this trade more room to breathe. That's all nonsense. Never move your stop against you. Learn from your mistakes, all right? Make sure you learn from your mistakes, and you do that by keeping a trading journal. As I said earlier, keep a trading journal, keep a record of those trades, and you'll start to see patterns in your own trading and also patterns in your own risk profile. And as always, have a maximum loss or retracement in profits, okay? And that's for your overall, account, okay? Just make sure that you have a number in mind that you can follow with ease. So to conclude, before we just have a quick look at the markets as they open, all right? As I said earlier, money management is one of the simpler topics to grasp, though it seems to be a very hard one to follow for many traders. But it's actually, spend a little bit of time understanding, it's not that difficult. And what happens is you can overcome a lot of bad luck with proper money management techniques. Okay, I implore you to understand them, find them, and utilize them. And by, proper money management techniques, that allows you to stay in the game and develop the skills and experience for you to profit from the markets. And I would say, if you only take two things from the whole of today, is that A, never risk more than 1% of your capital in any single trade, and never ever trade without a stop loss. If you can do those two, okay, and refine them in terms of where you place your stop loss and how you can achieve and understand the risk to reward, then that's excellent behavior, okay? And it is the right habits and the right behaviors of good traders. As I've said, in all of my years, I've never seen a long-term sustainably successful trader who didn't manage risk, okay, exceptionally well. It can be your edge. Okay, before we switch across to the live markets, just a reminder that we'll be here next week, okay, 16th of December, 2 till 3 o'clock London time, Monday Market Matters, how to make the most of the daily charts, all right? How do we utilize them best to help us with, our analysis and our trading decisions? So by all means, register on the ActivTrades website or take a look at the QR code there. Either way, I hope you'll join us for that. And as I mentioned a few times, remember that you can follow ActivTrades on YouTube. They have our own YouTube channel. So be sure to go on there, just invariably search for ActivTrades and then make sure that you subscribe. And what will happen is these sessions here and other ones, you will find that they will basically, they'll also be uploaded there, as also along with the on the webinar archive section of the ActivTrades website. Thank you, Simon says, thanks for all your work and knowledge, Paul. You're very welcome, Simon. Okay, that's fabulous. Yeah, by all means, make sure you can make the most of that. And yeah, thanks for the feedback. And that's a kind of nice for the next slide. As you can see there, if you've got any questions or comments about ActivTrades, please feel free to contact your account representative. You can see it there, the English number there, or the English desk at activetrades.com. If you've got questions or comments, you've got feedback, or there's topics you'd like to see me touch on in the future, by all means, push that there, and we'll be happy to help you. Now, if you'll just bear with me for a moment, we'll switch across to the charts and have a little a look at the live markets. Florian says, "Thank you. You're very welcome. Thanks for joining us here today." So, just bear with me a moment, and we'll switch across to the live charts. Okay, so what we've got here is one of the ActivTrades platforms. I have it as a profile as mostly for my indices and commodities. So I've got the Dow here, the Nasdaq, the S&P 500, the Russell. Then we have the FTSE 100, the Nikkei, the DAX, and oil. Just so you can see it there, it's all on the weekly channels, on the weekly chart. So we can have a quick little look. What am I interested? What's intriguing me? Okay, at the moment. So what we could see is last week, okay, on the Dow, all right, we did have we had a weekly close, another weekly close at all-time highs, all right. But we'd come off it last week, okay. We came off it last week. We're still, still in a bullish uptrend, okay, but we had a little bit of a bearish close, all right, on the Dow. Whereas on the S&P 500, we closed at highs. On the Nasdaq, we had a really strong week and closed at highs, and on the Russell, we kind of rolled off a bit like the Dow. So we had a little bit of a mixed picture. The Nasdaq and the S&P were very strong, as opposed to the Russell and Dow. But they're still in an uptrend. Okay, we're still in a strong uptrend, and as I'm telling you, traders, don't fight strong trends. There's no point with that. Eric says, "Thank you, valuable as always." That's great, Eric. I appreciate the feedback. Thank you very much. Talking of other strong closes, a little bit closer to home was also we saw that in the German DAX here. And it's this is a very, we can see here for the last year, it has been in an uptrend. And this is, the DAX is the German index. And it's fascinating to see that we have continued higher despite the uncertainty and the bad news coming out of both Germany politically and economically, and also from France politically and economically. But you can see, that has not stopped the DAX at all. The DAX has powered to new highs, okay, off the back of some of the particular shares. And we can see last week was a really strong closing week, okay, really kind of a big strong move there we can see on that. And you can see on the daily chart. On the daily chart, we had been, okay, in this kind of bearish channel, bearish flag pattern, and what we can see is that once we broke out of it, we've had a strong move, haven't we? But based upon what we were saying, well, Paul, if you'd been trading that, where would your stop loss gone? Well, we have fractals here. Depending upon your risk profile, stop loss could have been here, or maybe here, or here on the other side. The other side, okay, of the flag pattern, on the other side of that line of support, depending all upon your own particular risk profile, but at least knowing exactly what that there are a couple of good places to put your stops there that you can help manage your risk. All right, so with just a couple of minutes left, why don't we have a little look at how as always, I like to just finish with just how the US indices are starting off for the start of the week. As I say every week, I normally give the first 15 minutes a bit of a miss on the markets. Okay, they can be a little bit volatile. I tend to let the market do its thing, and then after the sort of what would be 9:45 Eastern time, or 2:25 here in the UK, or would be 3:45 in Europe, etc. And then I start to look to be engaged. So the Dow, just let's have a little look at what's been going on here, where the highs and lows of the days, just to basically make sure that I'm aware of them. 15-minute chart, so I can look at what was that first 15 minute that I kind of missed. How was it looking? Well, we can see that was quite some bearish candle, wasn't it? Quite some broad range candle that we find ourselves there. That's the 5-minute channel. Dow has definitely been bearish. The 1-minute candle has been definitely bearish there at the entrance. If I look at the Nasdaq, okay. So Nasdaq, as I said, just looking at where the highs and lows of the the overall electronic session from today, using that as information. Okay, first 15-minute candle once again. It's interesting that the Dow was very bearish. It might be said the Nasdaq was quite bullish. That was the 15 minutes there. Let's go down to the 5-minute chart. We can see, we had a rally up there. Okay, hit the 200, hit the highs, and we've reversed off that. Yeah, I look at that now. That's a very nice double top there. Okay, on the Nasdaq, I'd be looking for it to maybe, if it breaks that 200, to move down towards those lows. Okay, and that's what I'll be focusing on after after we kind of go live or I go live in a few moments. Looking at the S&P 500. Okay, on that 30-minute chart. Okay. Look, as I said, just looking at where the kind of highs and lows for the day were so far. Have a look at how we opened up. There's that first 15-minute candle. It's not as extreme as the Nasdaq and the Dow. As you can see, it's actually quite quiet relatively there. Let's just bring that into that. Yeah, there's sort of kind of, it's drifting, it's bearish, that first open, but I would just be looking at, we can see the Russell really has been flying. But yeah, I'd be interested to see, what fascinates me at the moment is that normally I like to see all of the indexes, operate, in a very close correlation, but there's, that's not really happening at the moment. We can see, hopefully you can see, the Nasdaq had a nice double top. It might be said that the Dow had a bit of a false breakout, which double bottom, and the S&P is a little quiet, and whilst the Russell has just seemed to have flown higher. So they're all doing their own thing, which means you just have to trade what you see in front of you, and just make sure that you're able to keep on top of your analysis. Okay, and as I said, you never trade without a stop loss. You only ever risk a small portion of your account on a trade. Doesn't matter whether you're trading a monthly chart for the next 6 months to a year, or whether you're looking at a 1-minute chart trading for the next 5 to 20 minutes. Okay, that's what we're particularly looking at. So it's clearly it's clearly getting ready to make a little bit of a move this afternoon. So I'll be getting ready to do my own trading in the next few minutes on that, based on what we see here. Okay, ladies and gentlemen, so as always, time flies when you're having fun. Unfortunately, we're out of time for today. Thanks very much to everybody for joining us. I hope that you found that useful. I hope that's just for the new traders, that it's just reconfirmed the importance of risk management and how you can go about it and how you do it, how you have those rules. Basically, always live to fight another day, and never enter a trade without knowing where your exit plans are, knowing where your entry is, knowing where your exit if you're wrong, knowing if your exit where you're right. From that, being able to work out your position sizing. Okay, from that, being able to work out your risk to reward ratios, so that once you're able to do this every trade, almost like it becomes automatic for you. That helps you in just managing risk. And as I said, all great traders are very, very good at managing risk. Have a fabulous week, everybody. Trade well, and I look forward to speaking to you next week when we'll talk about how to use the daily chart in our trading. Trade well, everybody. Cheers.